Hello, this is Ed Burke with PlaceForTraders.com. In this video, I wanted to emphasize the importance of using multiple time frames when you're looking for trading opportunities. Now, this applies to support and resistance lines as well as technical indicators. I'm going to be talking about the relative strength index momentum oscillator a lot in this video. But multiple time frames are so important because just using a single time frame like a daily chart will produce several buy and sell signals with limited success. I'm sure that many of you watching have used indicators on a daily chart only to find that the indicator may give good or profitable signals about half the time or maybe even less. If you're position trading, you should always be looking not only at daily chart but weekly and monthly charts also. Now obviously in these examples I'm going to use, I have the benefit of hindsight. These are not trade recommendations. It's intended for educational purposes only. Here I have a daily chart of the orange juice. When we're looking at the orange juice, obviously we see here in February the market went down to a low of 63 cents. And now we've seen a little rally in the market from there. Now going back and analyzing this daily chart of orange juice, one could say that if we were back here in late last year in December when prices were trending lower, we see here in the relative strength index that there was a bit of a bullish signal that the market, the relative strength index was failing to trend lower like price was. Now, obviously, there was a little pop in the market. The market went up, but then continued to trend lower. Now, I'm going to switch gears, and this is a daily chart of orange juice. I'm going to switch now to a weekly chart of the orange juice and see what the picture looks like there. Here's a weekly chart of the orange juice. We're seeing here late last year the market was trending lower on these weekly bars. I drew a trend line across those lows. When you're looking here at the relative strength index, those lows are higher. We keep seeing higher lows in the relative strength index. So basically that's not giving you really great signals. I mean, we've had some false signals in this relative strength index going all the way back to late last year. If you would have kept buying the market every time you've seen divergence between relative strength and the price, that didn't give you very reliable signals. I'm going to switch gears and go over to the monthly chart now. If we look at a monthly chart of orange juice, I'll get it up in 1 second. Here's a monthly chart of orange juice. Looks like a totally different picture. Going all the way back to 1997, I drew this trend line across here. 1997, the market went down to 63 cents. It was a great support level. Back here in 2000, the market, orange juice went to 63 cents. Was a good. Here's the only time we went to 63 cents and went under 63 cents to the low 50 range. And back here in 2009 is 63 cents. So what does that tell you? When the market was trending lower, obviously knowing beforehand, you could see that 63 cents was a pretty good support level. So you have that as a reference. Now, obviously, you use a shorter time frame like a daily chart for your signal. But knowing that beforehand that the market could trade down to as low as around 63 cents, that's a support area, could be very helpful if you're trading orange juice or interested in getting involved. Now, I'm going to switch over to a different market now. I'm going to talk a little bit about the Japanese yen. I'm going to put up a daily chart of the Japanese yen. Here's a daily chart of the Japanese yen. We could see back here in December of 2008, obviously the market made a high right there. We sold off. Then the market made a double top here in January. Pointed here, I drew a trend line across these two highs. Drawing a trend line across the corresponding time frames in the relative strength index on a daily chart shows a bearish signal back here that the market could turn around. That was bearish where the relative strength index failed to go up to the same level. It's illustrated here. Okay, that's a daily chart. Switching over and trying to get some confirmation, looking at a weekly chart of the Japanese yen. Here's a weekly chart of the Japanese yen. Here's the same time frame. Each one of these bars represents 1 week. So we see here in December and then January. We see this double top. I drew the trend line across here, drawing the trend line across those highs in the relative strength index. Once again, it's given the same kind of signal, that bearish signal. If we move over and put up a monthly chart of the Japanese yen now. Here's a monthly chart of the Japanese yen. Now, obviously in a monthly chart, because you're talking about December and then January, those two bars are going to be right next to each other. So there's on the relative strength index, they're still part of the same move up because they're too close in time frame. So if we drew a trend line across at the beginning of 2008, that last high, you see the trend line. Obviously, the trend line going across those two highs are higher. We could see that on the monthly time frame, if drawing a trend line across those two highs in the relative strength index, pointed slightly lower. So once again, that is another bearish signal on the monthly time frame. So you have corresponding bearish signals on daily, weekly, and monthly charts back in January for the Japanese yen. Now I'm going to switch over to the pork belly contract. This is going to be something entirely different. I'm going to talk a little bit about patterns in the market. Here's a monthly chart of the pork bellies. I drew arrows in the last 7 years, going back from 2008 all the way back to 2002. Each one of these arrows, I'm actually pointing to this is a monthly chart. Each one of these bars represents a month's worth of trading data. So I'm pointing to the month of August here in 2008, 2007, and so on. Now, what's interesting about the month of August is there's obviously evidence of that the month of August has a lot of volatility. And what I mean by volatility, obviously, is big trading ranges. We see a really big trading range right there back in 2008. Another really big trading range right here in 2007. Another big trading range here. This in 2005. One could say that's not really that big of a trading range. Another big trading range in here. 2003 wasn't an especially big trading range. 2002 was another big trading range. So out of the last 7 years, 5 of those years we've had extremely volatile months extremely volatile trading in the month of August. Now, as the story goes for seasonals in the pork belly market, August is supposed to be a bearish month with a lot of deliveries against the July futures contracts, more supply in the market. July, August are supposed to be bearish months for the pork belly market. Now, obviously, seasonal tendencies have their limitations. They're not always right. In fact, just looking back at the last 7 years, they're right about half the time. The market was higher actually at the end of August than where it started 3 of the years. It was lower 2 of the years, and then the other 2 years it went back to about the same level, even though it was very volatile, like right back in here in 2007. Extreme volatility, but the market ended up coming right back to the same level it was at. So what does that tell you? Maybe it tells you that if you have this big sell-off in the month of August, you want to buy it then, because the market tends to go right back up in the next month. It might tell you if you don't like volatility, if you don't like wild volatile markets, you want to stay the hell out of pork bellies in the month of August. But at least knowing this information or noticing patterns in the market, you're forewarned. Forewarned is forearmed. So that's all I have. I hope this video was helpful to you, especially for those who are trading and struggling and not using multiple time frames in their analysis. Thanks a lot for tuning in, and good trading.